My name is Nicole Abney. I am a cost analyst for the company. I will be presenting the board with a marginal analysis for the oil company X new pipeline expansion construction. We will be looking at the specific project and conducting a marginal analysis on there. First, I will talk about what a marginal analysis is. It is when we look at the additional benefits and the additional cost of an action or decision. Before making any type of significant investment, a company needs to conduct a marginal analysis to make sure that this decision or action is truly beneficial. Marginal analysis process, okay? We will be looking at the three components of a marginal analysis. So these are the three things we'll be looking at for our investment into expanding the pipeline. The first is looking at what the marginal benefit is. The marginal benefit is any additional benefits gained from the production of one more unit of service. So what do we tend to gain as a benefit from investing into the expansion of it? What additional benefits do we get from any more product or service in a unit level gained? Marginal cost, that is the cost of the production from producing that additional unit. So it's not looking at the total cost of a project, it's looking at what do you have to pay, not just monetary, for that additional unit to get that additional benefit. Lastly, we will be looking at opportunity cost. This is the cost in terms of output of producing another unit over another unit. What this means is, are we missing out on anything else by producing this additional unit, and in producing that unit over the other unit, are we at a positive or are we at a negative? So when we talk about marginal analysis, those are the three components that we look at. Now we will look at it more in terms of this specific project. Marginal benefit, okay? So let's look at what we tend to gain from the additional units expanding with the new pipeline expansion for company X. The first major marginal benefit, and really the only benefit, is higher revenues. How do we get those higher revenues? By producing more units, we will increase the output of what we are able to sell. Then when we look at expanding geographically, we are entering new markets where we can access a different consumer demand, not only just domestically, but internationally if we're talking Canada. So by us increasing the amount of output and servicing additional markets, this allows us collectively to increase our market share. So increasing our market share, that would yield revenues and then profit, in which we could invest in other capital adventures that we are looking at. So that is the main only marginal benefit estimated during this marginal benefit. Marginal cost. Remember, this is the cost in which we are producing that additional unit. I want to talk about the law of diminishing returns because we talked about higher revenues, okay? The law of diminishing returns states that profit increases at a decreasing rate. So once you maximize your profit, it will continue to decrease the amount of percentage yielded over that profit. What this means is, when you make that initial investment, yes, you see a profit, but to maintain that initial investment may be labor, maintenance, taxes, etc., you are decreasing the amount of profit year over year at an unknown rate. Marginal cost cannot exceed marginal benefit. That is, if it costs more to gain that additional unit, it is not a good business decision. You must maximize the total benefit, but that can only be done if the marginal benefit equals the marginal cost. So once those two are equal, you have maximized that benefit. Now that kind of goes into externalist cost. So this is a side effect of commercial activity and the effect on other parties. So this is not directly impacting us as a pipeline expansion beneficiary, as us as a company. It is, what is the cost of this action that will impact others. So as we take over more territory to build this, we increase the exposure to environmental conservative groups and laws. So we will be more exposed to different social media, more publicity, also to other liabilities by acquiring different land in different areas. So along with that, it may not impact us directly, but there are other groups and governments that will be impacted by the decision that may impact us. Now, when we talk about Canada, we are now entering internal presence with labor practices and abroad. Once again, this is another externalist cost where the attention going to a foreign land, we must be conscious of what that looks like for brand recognition of our company. Opportunity cost, okay? Remember, this is the cost of producing a certain recommended unit over another. So by us using the funds to do the pipeline expansion, what are we missing out on using that funds to produce something else? So if we use our funds to expand the pipeline, we tend to gain a profit of 8% after the 10-year initial investment for the pipeline construction. We also have a return on stocks. In that same 10-year period, we will average a 10% return on our stocks. So, oil company X can produce higher income with a 10-year period from stocks than pipeline expansion product. There is a higher opportunity cost for the expansion project than the comparative advantage of stocks. We will not be able to yield the same amount of profit using the same amount of money if we do the pipeline expansion project. So the opportunity cost in doing this is higher than if we did stocks. And if we use those same resources, which is a comparative advantage, we could yield more money in the stock return. So, in conclusion, when we look at the three factors of a marginal analysis, we talked about the marginal benefit and we talked about the marginal cost. The opportunity cost and marginal costs exceed the benefits. This is why this is my recommendation that the pipeline expansion project is not beneficial according to the marginal analysis. The increased revenues and profit potentially gained from the investment will not be sustainable. Remember, we talked about the law of diminishing profits. After the 10-year period, we do not know what we will lose in profit at what rate from that initial 8%. It can go from 8% to 2%. We do not know. So, as a recommendation, I am recommending a comparative advantage. We use the stock returns of 10% for that 10-year period, and the profits yielded from that 10-year period could be used to fund the expansion for a time period where marginal benefit wouldn't exceed marginal cost. So we talked about total profit maximized is when marginal cost equals marginal benefit. So whatever that time period is that they would equal each other, we would use the stock returns to fund the pipeline expansion so that the board will get the support that it needs to expand, but also to will not be in a manner where it will not be beneficial. So this is my recommendation based on the marginal analysis of looking at opportunity cost, marginal cost, and benefits. If you have any further questions or explanations, I will open up the floor.